Hi there, welcome to Alternative Investing. I'm Andrew Bell. Here's our Friday co-host, David Kaufman, president of Westcourt Capital. Great to have you here.
Always good to be here.
This, of course, is the show where we shift our focus away from stocks and bonds to explore investment concepts that may help you break away from the pack and potentially capitalize on some big gains. On today's show, we're talking about emerging trends in hedge funds. We've got a great guest later in the show. Gary Ostoich has been in the hedge fund business for more than 2 decades and was instrumental in bringing a major gathering of the industry to Canada. Now, David, just looking out there, though, at the landscape right now, what's the hottest trend in hedge funds right now?
Well, I certainly will be able to talk to Gary about this. What I see when I do my analysis is that you see the emergence or the reemergence of multi-strategy funds, which really means that if you look at the offering memorandum, the offering documents, that you'll see that the manager has the ability to be tactical, to do one thing on one day and a different thing on the next. Typically, of course, they will focus on a certain area. So they might have multi-strategy credit or multi-strategy equity because if they're just pure old multi-strategy, that means they're trying to be everything to everybody. And one has to then question, from where they get that broad expertise. But if the managers that tend to focus on one specific strategy, there may be a time at which that strategy, as sound as it may be under certain circumstances, is not always the way to go under different circumstances.
It's hard for investors to be patient because a drought like that can last for 3 years.
We talk about that all the time, that, the irrationality of the markets can outlast your solvency.
Fair Canada, the investor watchdog, is out today with a call on the government to finally get serious about investor fraud. According to them, more than 1.3 million investors have been a victim of fraud, and a lot of this, a big chunk of it, involves the exempt market for so-called sophisticated investors. So it looks like this area needs more policing.
It does. One of the items that comes up often when you get the national debate about whether we should have a national regulator involves the exempt market, and that's because the rules regarding the exempt market and the sale of exempt market securities is quite different from one province to another, having so many different regulators across the country. And so what you'll see is, let's start with the idea that fraud is fraud, and we've seen fraud in the largest public companies just as much as we have in the smaller world. Of course, the Madoffs of the world, I'm sure we'll touch on that later as well with Gary when our guest comes, certainly bring to light some of the problems that one could face in the hedge fund world. But I think that what has to be looked at very seriously is the concept of whether the fact that someone is accredited makes them sophisticated. Because whether someone has money does not necessarily tell you whether or not they understand what they're getting into.
Because sorry to interrupt, this blew me away. An article in the Winnipeg Free Press says that in quite a few provinces, and I think this is pretty prevalent in Western Canada, an investor just has to say they have assets, and they don't check it out.
Well, it's largely, yes, it's true. I mean, the people the dealers whose job it is to sell these securities have to do a certain amount of homework, but there's only so much policing they can do. And so at some point, when the investor checks off that, yes, I am accredited, or yes, I've read the risks, yes, I've read the offering memorandum, at a certain point, it's buyer beware. On the other hand, because you're talking about a market that is generally illiquid, if it turns out that investor changes their mind later, it may be a little bit late, and they're talking about an illiquid market where they might be stuck for months or even years in an investment that they didn't properly understand. So this is why we've talked about this a number of times on the show in the due diligence process, that the investor should do as much of their own heavy lifting as they can. Seek advice for sure, but take the time, for example, to read the offering documents.
Who
it's
does
boring.
That?
Well,
Yeah.
very few people do.
Yeah.
But that's sort of where the secrets are buried.
Sure.
And in most cases, putting fraud aside, the rules are followed, and those rules might be a little bit different than what a salesperson may have intimated. For example, during a phone conversation, during a sales call.
Your money could be tied up. You might have penalties.
And actually, you've pointed on two things, of course, that are especially important. That you need to know how long you're in for, what you're in for, and if you want to get out early, are you going to be able to get out? Are there gates, which means that they can stop you from getting out early? And in some cases, they might apply a penalty to you. That should be clearly identified in the offering memorandum. And if someone is going to make an investment that is a material amount to them, whatever the amount may be, then I would admonish them to take that time to try and read the document, as boring as it may be, because some of it is in plain English, and that's the part probably that's most important, to understand the rules.
But in Ontario, the rules are fairly more strictly enforced?
Well, I don't know if the rules are more enforced, but they're stricter rules. And so that in Ontario, there's no such thing as an offering memorandum exemption, where just the existence of an offering memorandum means
Gets you off the
that
hook.
basically anybody can invest. You have to be an accredited investor in Ontario, or invest a minimum amount of $150,000 into a single investment.
And an accredited investor, it's family income of $300,000 or investable assets of $1 million.
Exactly. And investable assets, just to make this clear, does not include, for example, your house. It's investable assets. And so the regulators determined when they made those rules that if you have $1 million in investable assets, that you are de facto considered to be sophisticated, and that you can make up your own mind, and you can afford to seek either legal counsel or advice from an investment professional who's able to tell you what you're getting into.
You draw our attention to this story. This sounds perilous. Rock and roll drummers, they don't always get a lot of respect, but the former drummer of Pink Floyd is behind a group that's going to spend or invest something like $150 million in fancy cars.
Yeah.
That sounds risky.
Well, it is certainly an alternative investment, no doubt about that. I was reminded of the Pink Floyd song Money, where they say, I'm in the high-fidelity first-class traveling set, think I need a Learjet. So apparently he set his sights a little lower, and instead of the Learjet, they're going after the classic cars. But it is important to understand that, especially in Europe, where this story emanates from, which is sort of on the cutting edge of alternative investments in many ways, and we'll talk to Gary about that later, I'm sure, that you see collectibles becoming very important alternatives. So it's not just classic cars. We have wine, art, rare books, shotguns.
English shotguns.
Anything that can be on Antiques Roadshow could theoretically could go into a fund in a diversified pool. And people like Christie's and Sotheby's, of course, make a lot of money auctioning off these collectibles to the public.
So it's so illiquid, and also the auctioneers take these big commissions for selling it.
They do. That's one of the important things that a lot of people don't recognize, is that if you are in a wine fund, and we are probably going to do a whole show on wine funds because they're serious business, and it's sort of ironic to call a wine fund an illiquid investment, but it is. What happens is that when they publish their NAV, their net asset value, that's what the retail value of the wine that they have in their store is.
What a buyer would pay, maybe.
What a buyer would pay. But that's different than what you would receive if you were the vendor, because the vendor pays the commission. So if an auction house is selling a block of Bordeaux for $1 million, it's possible that $900,000 or less would go back to the investors. And that's just something that an investor into a fund like a wine fund should consider, because, of course, although there are commissions in the disposition of, say, equities, if you're in a mutual fund, they're nothing compared to the kind of commissions that we're talking about to sell these relatively illiquid assets.
Well, coming up, we're going to talk to the chairman of the Alternative Investment Management Association of Canada. Gary Ostoich is next. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital, and today, of course, we're talking about emerging trends in hedge funds. We're also going to talk about regulation. Our special guest today has been in the hedge fund industry for more than 20 years. Gary Ostoich is chairman of the Alternative Investment Management Association of Canada. Great to have you here.
Thank you, Andrew. Thank you, David.
He's also president of Spartan Fund Management. What have you been doing then for 20 years in hedge funds?
Oh my God, how long is this show? I started off on the legal side in terms of representing hedge funds, and as my wife complains about, talk to a lot of traders. So I don't know, I just got the industry itself became very interesting, and so I started to migrate, specialized in hedge funds on the legal side, helped to start off the association of AIMA in Canada in 2003 with two other individuals, David Jarvis and Jim McGovern. And then ended up leaving the legal side in 2004. So, it was seen that hedge funds actually from a number of different perspectives, first from the legal side, and then when joining the hedge funds from the operational side, and obviously the legal background, seeing it from a regulatory and policy development.
And even though we're here today to talk about current trends in hedge funds, I'm interested in the 20 years since you were acting, as a lawyer in the securities side. What has changed in terms of the way the public views hedge funds and how hedge funds are actually constructed?
Yeah, the perception of hedge funds, at times hasn't been great. I think what ends up happening, like anything, you get an incident or two that all of a sudden hits the press, and whether it's Madoff or another incident, and all of a sudden people end up gravitating towards that impression of hedge funds, which, hedge fund, Madoff wasn't a hedge fund. It was a fraud. Somebody was pretending to be a money manager and said, here are my numbers. So unfortunately, but the press, hedge funds is a topic that people like to point their finger at. But, for the most part, David, the hedge fund industry has evolved enormously over 20 years in particular.
Just tell us briefly about AIMA, the association. What does it do?
Yeah, AIMA, which stands for the Alternative Investment Management Association, is headquartered in the UK, and it represents about 1,200 corporate members. There's a slide, I think, that's coming up right now, and in more than 40 countries. And the mandate of AIMA is really to focus on policy development, education, and also, and through that policy development, interacting with regulators, producing educational material, producing manuals that help hedge funds best practices, to adopt best practices. And also they are actually co-founder of a designation called CAIA, the Chartered Alternative Investment Analyst designation, which really is like a CFA focused on the alternative industry. So AIMA globally is that body. The members of AIMA are hedge funds, fund of funds, administrators. In Canada, as I mentioned, we started the chapter in 2003 with about 10 members got together. Today, we're over 75 corporate members, over 250 individuals take part in AIMA.
Are the dealers in there, though?
Yes, they are. So all the prime brokers, the main prime brokers are involved in AIMA. We put on a number of monthly events. You can go to our website. A number of those events are available not only to AIMA members, but non-AIMA members. We just had one a couple of days ago. And we also have a research award, actually, AIMA Hillsdale Research Award, that recognizes research in the paper in the Canadian industry.
You use the term policy development and communication with regulators. Now, is that a bit of a euphemism for lobbying for what AIMA's members want to see the regulators come out with?
Sometimes, often, it's unfortunately, given a body where you have a number of volunteers, you're often reacting to things. So a good example is in the EU. In Europe, there was a draft directive commission that came out a couple of years ago, actually, that was effectively going to shut down the ability of non-EU hedge funds to access the European marketplace. So what AIMA did become involved in was, in particular in the UK, was heavy lobbying with the politicians, with the regulators. It really, for the most part, our lobbying is education. It's to make them understand what are hedge funds doing in the marketplace. Is there a benefit of hedge funds to the marketplace? When the market is down 40%, who's buying? There are strategies within the hedge fund marketplace that the buys take place when the market's going down. And without those, if you're going to erect walls to stop those participants in the marketplace, you're going to stop liquidity in the marketplace. So that's a lot of it, David, is that.
You've got an event you'd like to plug. Tell us about it.
Yeah, it's not my event, but it's an event that I'm speaking at.
And
it's an event that's taking place in Toronto next week. It's put on by Introcap. And Introcap has asked me to give some opening remarks. Introcap by Karen Aslan, who's been in the industry for quite some time. She's got together a really strong group of people to speak, other than myself. So, there's a number of managers, private equity, commodities, and actually family offices, which are a very interesting group to get together because these are ultra high net worth investors who are usually on the cusp of new things looking at the alternative side. So that's taking place next week.
And I'm going to be the MC, so I'm going to make sure that we keep the trains running on time.
But who is it for? Can the public go? Or?
Yes, public can go, as well as I know investors as well, in terms of accredited investors.
The Canadian hedge fund industry, what's the status of it? I mean, it took a battering like everything else, presumably in 2008. What can you give us some numbers or an idea of how big it is?
Yeah, like the Canadian industry, the hedge fund industry as it stands right now is about 107, and this isn't AIMA data, but rather data that I look to collect when I talk to individuals in the marketplace, and whether these individuals are prime brokers, investors. And there's a slide that shows 175 to 200 managers, assets AUM of around 40 billion.
In Canadian hedge funds?
Yes.
That's
and these
pretty
are
substantial.
And actually, these are managers that are situated here. So this is excluding a manager that's offshore that's marketing into Canada. And, the strategies, I think the big thing on the Canadian side, we have seen a real change on the number of strategies being offered into the Canadian marketplace. 5 years ago, long bias managers dominated the strategy by way of AUM and number. I think if you look today, long bias managers are still there, but actually the other strategies actually are a bit dwarfing them in terms of AUM. So we're seeing multi-strats. We're seeing event-driven.
And as you talk about different strategies, AIMA clearly represents the hedge fund world. Where does private equity and commodities and other types of alternatives that we discuss on this show, does that fall under the area of AIMA, or are they off to fend for themselves?
AIMA's alternative investment strategies, so actually, technically, any of those strategies could be in it. The reality is private equity have a lot of their own lobbying bodies, but we do have members of private equity in AIMA globally. Commodities, definitely. Commodities usually are a sector that people are accessing by way of future strategies or equity strategies, definitely. CTAs, commodity trading advisors, are members of AIMA in a large way.
And could you just look at this question, like hedge funds, they were originally supposed to eliminate a lot of market risk, but we got these characters going out there with basically long-only funds.
Yes.
Is that a thing the industry needs to address to get a proper definition of hedge fund?
Well, it's really to step back and what is the definition of hedge fund. The better word is alternative strategies, alternative investment strategies. And I think you have to say within alternative investment strategies, some strategies do hedge, some don't hedge. But that doesn't mean there's not a benefit for that strategy within your portfolio. And let me give you a quick example. Managed futures. Managed futures are people that typically are looking for global trends in futures contracts. So they're not hedging. They're actually going to latch onto a trend, and whether that's a cotton trend, a currency trend, and ride that trend. That's not hedging. But if you bring that managed futures strategy into your portfolio, you'll often find out that that is providing you beneficial correlation within your portfolio. Your portfolio would have otherwise been killed in 08, and otherwise it gives you an uptick.
That's interesting. What we're really talking about there is hedging your portfolio by diversifying the correlation among the different aspects of that portfolio, even though any individual strategy might be a long-only or a short-only strategy that isn't hedged itself.
Right.
It provides that diversification benefit when you look at the whole portfolio together. Is that right?
Yes, that's exactly right. And in terms of strategies being long biased, Andrew, I don't think that means they shouldn't be hedge funds. People just have to know what they're buying in terms of that strategy. There is a place for that in your portfolio.
Well, coming up, Gary Ostoich is sticking with us. We're going to find out why some or many Canadian hedge funds seem to get to 30, 40 million, and they get stuck there. What's the problem? We'll have more after this. Welcome back to Alternative Investing. I'm here with David Kaufman, President of Westcourt Capital, and we're talking about emerging trends in hedge funds. Our guest is Gary Ostoich, Chairman of the Alternative Investment Management Association of Canada. Great to have you here, Gary, and President of Spartan Fund Management. Bernie Madoff, the guy himself said, look, the regulators had to have known what I was doing. They were told, at least one whistleblower told them. So how has that changed the landscape, the Bernie Madoff scandal?
It is very clear from the report that was released by the SEC, that the regulators did a dismal job in terms of there were a lot of flags that were raised relating to Madoff and just a lack of follow-up. But I think as well you can't just blame the regulators. I think you have to look also at the investing side. What was going on? Why were people going to Madoff despite the fact that there's so many red flags? And let's be clear, I'm not aware actually of any Canadian fund of funds that invested into Madoff. So it's not that everybody was fooled by Madoff. Madoff, though, did attract a lot of investors, and it highlights the fact that ineffective due diligence was done. And I think from the investor side, you have to look at, there's two parts to that due diligence. First of all, what checklist are they using? And also, what governance is the investor using? In other words, if I'm an investor looking at Madoff, I have an operations team that's checking them out. If I have a CIO who's going to make the investment decision, it's clear from the press that I read that the operations team were sometimes saying, this isn't a good investment. The CIO was saying, let's go forward anyways. And I think that's just not Madoff. That's investing in general, which somebody says, my God, look at these returns. They're too good to be true. I want to get in.
Well, and usually when you take a look at these things, especially after the fact, you can point at one specific element that alone was enough of a red light. And what I hear from the CFAs and the CAIAs that I speak to in this country is that it all comes down to the auditor in the case of Madoff. Not that there weren't other signs, but when your brother-in-law, who's in some strip plaza, is trying to audit a $50 billion fund, that alone should be enough of a red light. So who along the way should be picking up those signs and putting up the stop sign?
It's what I call the so-called gatekeepers. And I define gatekeepers as investors, service providers that allow an entity to conduct operations. So remember, this isn't just applicable to hedge funds. It's applicable to money managers. It's applicable to businesses. Let's face it, we have frauds on public companies that have occurred. So, it's really in terms of those people, are they picking up that group? Are they going through their due diligence to say, does this make sense? The auditor issue that you mentioned, David, absolutely. The other one being they were actually their own prime broker. They were clearing their own trades. People saw this. These are some pretty obvious red flags. So to address your question, Andrew, about the industry has changed quite a bit in terms of there's better questions being asked, due diligence processes. People are asking questions to hedge funds that bring out a lot of the issues that Madoff and, quite frankly, beyond Madoff can, would bring up. So that has changed. I think hedge funds themselves have changed. They actually are providing a lot more information to investors. And an investor has to decide if a hedge fund isn't going to provide some information. Transparency. Mm-hmm. Do you still, even some limited amount, are you still going to invest? At what point do you say, I'm not going to do anything? And to a large extent, you have to say, who's going to help me in this process to invest?
Well, let's talk about that. Transparency is a great thing. Of course, usually it's rear view mirror transparency because very few managers are going to share in real time what their trades are.
Right.
The issue that I have is we talked at the top of the show about the emergence of the multi-strategy funds being sort of best in class in many ways right now because they're able to do what they need to do under different economic circumstances. And the problem, of course, is that if I say I'm fully transparent but I can do anything I want, how does that help me before the fact in deciding whether or not to place my money with that manager?
Yeah, I think you have to be realistic about what transparency will get you, and it's not the panacea. First of all, I think transparency, if a hedge fund has, as you in your opening remarks talked about reading an offering memorandum, if it says I cannot invest more than 25% of my equity in private companies, how are you going to check that? Now, one way to check is the hedge fund governed properly. Do they have a separate compliance officer, risk officer who is monitoring that? Another way is once in a while getting a look at that portfolio. Now, most structures, most funds in Canada are required to disclose their entire portfolio to you on a semi-annual basis. And so, do you pick it up and you look through it and say, hey, listen, is there 25%? So I think that's part of it.
Could I jump in, David? Sure. Because I want to just, I promised the viewers this. You reckon a lot of Canadian hedge funds, they get to 30 or 40 million and they can't grow beyond that. Why is that?
And I think it's just not Canada. The life cycle of a hedge fund is friends and families, seed investors, and then from there they move on to family offices, fund of funds, institutions, endowments. As you move along that scale, it requires more institutionalization. Institutionalization doesn't mean institutional investors. It means creating a business that has separate risk management, separate compliance function. It requires that operation, a longer track record. So when you look globally at hedge funds, 30 to 40, whether it's in Canada or elsewhere, you've got to say, first of all, if you're 30 to 40 and been operating for a year, you're going to have a longer track record before people will buy into you.
And let's be clear, there are many managers in this country, notwithstanding the fact that they might be running a relatively small AUM, that are excellent at what they do. Canada does have some of the best managers in the world, especially in certain areas, don't they?
David, there was a study put out by KCS Fund Strategies, which is a fund of funds in Vancouver with Simon Fraser University in 2009. Research paper that basically said that exact thing. Canadian managers on a global basis have outstanding returns per risk.
On that note, we're going to have to leave it. Gary Ostoich, thanks so much for joining us.
Okay, thank you very much for having me.
David Kaufman of Westcourt Capital. We're out of time on alternative investing. Please get your questions, your suggestions into us at alternativeinvesting@bnn.ca. Thanks very much for joining us. Have a great weekend, everybody.